you sort of see a mixed bag here, don't you, for next week?
Well, I think we're going to get, at least from the consumer internet names, Facebook and Amazon, we should get two reads. One is that the online advertising market is very robust and is probably going to get stronger, by the way, going into 2020 because of the elections, Olympics. It's a big year for advertising. So we should hear that from Facebook. That should be the good news. We should also hear some good news from Amazon about the holiday season. It looks like the consumer was pretty strong in terms of retail sales, at least online. Amazon should have fully participated in that. So we should get that kind of good news. The one thing we've been warning investors and clients about at RBC is the operating income estimates for Amazon going forwards. This company is known for aggressive investment cycles. I've tracked them for 20 years. They never waste an opportunity to invest aggressively. I think a few areas that they're looking to do that, maybe physical retail, maybe groceries, much more in cloud computing, and this one-day fulfillment, shipping logistics infrastructure. So I'm just trying to be careful about the expectations. I thought they were a little too high. That's why we flagged it as an issue for Amazon next week.
Beyond Amazon, I'm looking at your estimates, Mark, for companies like Facebook and Uber, a target of $270 for Facebook. That implies a 23% upside from current levels. Uber, $64. That's a 75% upside from where it's trading at. What are some of the biggest risks to these quite bullish estimates?
Yeah, so I'll start with Uber. You know, it's actually our #1 pick for the year. You've got a clearly dislocated stock, very controversial stock last year, hated, broken IPO, massive losses. If Uber can bring those losses down and really prove to people that they'll get to break even in 2021, and if they can do that while maintaining reasonably consistent growth in that core ride-sharing business, I think the stock could materially outperform. It could be the Facebook of 2020. Facebook was really dislocated at the end of 18, and fundamentals stayed very well intact. The stock ripped 60% last year. I think that's kind of the setup on Uber. I know the sentiment's negative, and I think if they continue to do things like shut down the Uber Eats business in India, which they did earlier this week, bring down those losses, I think the markets will respond really positively. That's the bull case really on Uber.
Simplifying its business, streamlining it a bit more is part of the bullish thesis. But what about engagement? You see engagement rising from 13% to 50%. I mean, what needs to happen for Uber to really expand its user base? Does it come down to pricing or getting into new markets?
I guess it's a mixture of those and just increasing the overall functionality of ride-sharing. I just want us to step back a little bit. Where are we in this S-curve of adoption of ride-sharing? Our survey work found that it's only about 40% of U.S. internet users use ride-sharing, and of those who use it, only about 15% use it on a daily or weekly basis. So I think that penetration rate can double, that engagement rate, if you will, the frequency rate can double or triple. I'm just stepping back and saying this company could sustain 20% bookings growth in its core ride-sharing business for a lot longer than people realize. If you look at where we are in that S-curve, we're earlier than most people realize.
Facebook, whatever happened to that regulatory overhang we were all talking about so much last year? It's been pretty quiet lately. I mean, you got a lot of other things going on in Washington. It's also an election year. But are we going to see something in that regard this year? And what do you think it'll be?
Well, we did see something last year. They paid this $5 billion fine to the FTC. Now what you're going to see this year is anybody who's running for office is going to be using Facebook because it's the best way to target suburban moms in Cuyahoga County in Ohio as one example. Like, it's a very good marketing tool. It's what helped candidate Trump become President Trump. So you're going to see a lot of people try to match that. Will there be more regulatory risk? Maybe. I think what the company had is real brand damage a year and a half ago. And it just takes that long. It takes a year or two. I saw this with Netflix 5 or 6 years ago. It takes a year or two to work through the brand damage. And in the meantime, the ROI that advertisers see on Facebook hasn't changed at all. So advertisers are still there and consumers are still there, thanks in part, though, to the Instagram asset.
Lastly, I didn't realize till I read your note, Mark, that Snap, one of the best performing stocks last year, up 196%, and it's your highest conviction long. Do you think if you're not in the stock now, you've kind of missed the boat, given the big run we've already seen?
Yeah, thanks for the setup, Seema. It's not our highest conviction long. Our #1 pick would be Uber. I look at the, I think the trends, we upgraded the stock early last year. Maybe we got lucky. I think that they've done a lot better job of rolling out new features and initiatives. They finally solved the Android problem. The app wasn't working well on Android devices, and it's an Android world. It's not an Apple world, so you needed to fix that. They did. We've seen a really good cycle of innovation. There's just like a lot of good features on there, and this isn't a direct competitor to Instagram or Facebook. It's a communications tool for the vast majority of people who use it, so it's really sticky, and I think investors underappreciate appreciated just how sticky Snap was as an asset. So yes, it remains a long for us. We continue to like it. Not a top pick, but we remain positive on Snap.